In this video, I'm going to talk briefly about the FNB Commercial Property Broker Survey, which takes place around the major metro regions of the country, and more specifically to the components regarding property sales activity. Now, the first thing we do in the survey, and this is the first quarter 2022 survey, just by the way, which took place in February 2022. The first question we ask up front is a business confidence related survey question. And it's very simple. Are you satisfied with business conditions? Yes or no? Now, 47% in the first quarter answered that they are satisfied with business conditions. That's a pretty mediocre percentage, given that 53% would have answered that they're not satisfied with business conditions. So it's not really where ideally we'd want it yet. It's now very much in line with national business confidence as surveyed in the RMB BER Business Confidence Survey, where 46% of survey respondents say that they're satisfied with business conditions. So it's mediocre at best. But what's interesting is it showed a very sharp increase in this percentage from the previous quarter survey, which was only 32%. So we have been on an improving trend in business confidence amongst the brokers in recent times coming into 2022, and that's encouraging. We then take a look at the activity, the sales activity perception of the property brokers surveyed. Now, this is a perceptional question. We asked them to rate sales activity in the market they're operating in on a scale of 1 to 10, 10 being the strongest level of sales activity, 1 being the weakest. And we do it for the 3 major commercial property sectors, i.e. industrial and warehousing, retail, and office space. Now, on the scale of 1 to 10, the property class with the strongest rating, as it has been for quite some time, is the industrial market with 6.2. That's becoming a very strong activity rating. And there's quite a buzz in the industrial property sector at the moment. There has been for quite some time. We've believed it would be the outperformer, and it has been the outperformer for quite some time. Now, this 6.2 rating is the strongest on record, records dating back to where we started the survey at the beginning of 2019. This is the strongest level recorded that we've had. We think that the industrial sector or industrial property class benefits from a key structural change, that being the shift to greater levels of online retail and all the extra logistics and warehousing needs that this requires to deliver. It's also probably the case that this industrial property market benefits from being the most affordable property class and the most adaptable in the case of warehousing too. And affordability is key in a financially tough time, that's what we're in at the moment. Next comes the retail sector, quite significantly behind industrial with a rating of 4.87 in terms of sales activity perceptions. This sector too has been on an improving trend like industrial, but lags behind. And I think it's realistic. There's a bit of uncertainty perhaps in the retail sector when it comes to investment in that property class, driven by the unknown of how fast does online retail proceed and how and what is the future for especially the bigger retail malls. But I think it's more than just that. It's also about a financially constrained consumer. Retail tenants, if we look at TPN's data, their payment performance is the weakest of the 3 property classes, tenants in office and industrial space being significantly stronger. So the retail sector's tenants took a financial knock during the hard lockdowns and have struggled to bounce back fully to performance levels of 2019. So there's pressure in the retail sector. There's pressure on the consumer as well. The consumer is in a better state than 2 years ago, but the household sector sees its effective tax rates rising, be it the personal tax rates where bracket creep adjustments aren't fully made to compensate fully for wage inflation, where municipal rates and tariffs and electricity tariffs generally exceed inflation, and CPI inflation has also risen from a year ago where it was down nearer to 3% to up nearer to 6%, 5.7% the most recent reading petrol prices have been accelerating rapidly. So there have been some key sources of pressure on the consumer, and I think that holds back retail property performance, and that creates some uncertainty in the investor minds. I think that uncertainty is probably even greater in the office sector, where we have to wait and see just where this hybrid working model is going to land. 2022 seems to be the year in which office work normalizes from the forced work from home experiment, where those who are going back to the office go back to the office. I think that's been happening. But now we wait to see just what the occupancy rates on a daily basis in the office sector is going to be. Because I believe that not everybody's going back to the office like they did in 2019. A bigger portion of the workforce will stay at home permanently. A bigger portion will work at home for a bigger portion of their working week. So the question is, how much office space is going to be needed? It's a big uncertainty in the office market. And I think that keeps the office market with the lowest sales activity rating at 4.26, although that has also improved out of hard lockdown 2 years ago. So all three markets on an improving trend, but industrial the best, retail in the middle, and office still the weaker one, with a lot of uncertainty there around the future of work. Okay, so what is interesting when it comes to activity ratings is that they've carried on improving despite the start of interest rate hiking. Should perhaps not surprise us. The residential market is highly interest rate sensitive. You tend to find when interest rates get cut, the residential market's home buying demand surges quite significantly, and vice versa as soon as interest rates start rising. The commercial property sector typically is more economy driven, and the economy resumed its growth in the fourth quarter of last year. That's the most recent data we have, after a temporary dip which was unrest-related, KZN, Gauteng unrest-related incidents in part. But it got back on its growth path in the fourth quarter. And I think that the recovery in GDP levels and GDP growth after that hard lockdown of 2020 has to a certain extent been the key influencing factor in this broad improving trend in activity levels, and the market's seeing a normalization in economic activity as we go into 2022, with COVID-19 and all the lockdown measures receding in significance, not being that much of a threat anymore. So that's been the positive, I think, which has been driving this normalization in activity after the hard lockdowns across the commercial property sectors. But we need to look ahead and ponder to ourselves, can this continue? Well, we expect further interest rate hiking, and at some point interest rate hiking would make some difference to commercial property because it is a credit-dependent sector. It's a highly credit-dependent sector. We expect another 225 basis points worth of interest rate hikes this year. But it's not only about that. There are risks as well, unknowns which we don't really know how they're going to play out. And here I refer to the Ukraine conflict. This has brought quite a lot of negativity over the global economy and the global markets. We saw the oil markets concerned about energy supply disruptions as a result of all the boycotts on, well, the war itself, and of course the mounting sanctions on Russia and possible retaliatory measures as well. Those concerns seem to have been by and large alleviated, and after Brent crude made a turn at near $130 a barrel not so long ago, it's receded to nearer to $100 a barrel. So the energy crisis threat seems to have been alleviated somewhat, but there's a global food price inflation spike that could also happen. Agricultural economists are talking about it, with the Ukraine being a big agricultural producer as well. So it is conceivable that we can have an inflation surge. It's not only those two things. Increased sanctions and boycotts of Russia can lead to increased supply chain disruptions across the world of varying types. Supply chain disruptions emanating from COVID-19 have already been a major issue in the world and led to an inflation surge. And this, obviously, this can conceivably mean that we have higher than expected interest rate hiking. It's possible. So it's a key risk factor. Then there's China, with its renewed COVID lockdowns in certain regions, does that lead to some sort of supply chain disruptions and more inflation as well? We'll have to see. So there are some key global uncertainties going into the future. Will they start to dampen activity levels? We'll see in the coming surveys. Too early to tell, but the risks are definitely there, and the rising interest rate hiking cycle is already in play.